Good to see you guys again, and welcome to Simple Chew. In today's video, I will go over accounting periods and methods. This video is related to personal wages and taxes. Accounting period. Typical period covered by the personal income tax returns is the 12 months period from January 1st through December 31st. It's also known as the calendar year. A fiscal year is another typical accounting period. A regular fiscal year is 12 months period that ends on the last day of any month except December. Taxpayer will choose the type of accounting period or tax years when they will file their first income tax return. Next, we're gonna move on the methods, and the first one is the cash method. Most individual taxpayers use the cash method. If this method is used, the taxpayer must report income in the year constructive receipts. What does constructive receipts mean? It's an accounting term that requires an individual or business to pay taxes on income even though the money has not been received. What the IRS cares about is if the recipient of the income can control or utilize the money even when it's not in hand. Some examples of this cash method is checks received and it's available for the taxpayer without restrictions. Also, garnished wages is considered income received for the year. Garnished wages is money that is withheld by your employer to pay debts, usually from a lawsuit or a court order. Most likely, like a child support is one of the best examples I can give you guys. Income payment paid directly to third party from property owned by the taxpayer. This is also treated as received by the taxpayer, and it's usually from like a rent. That's the best example from that. Income paid in advance includes in gross income from the year received. That could be, like record deal give you an advance. That's also gonna be included in your gross income. One exception, and there is one exception, which is kind of rare, but do not report the interest or on Series E and double E U.S. Savings bonds until the final maturity date. Now I'm gonna give you guys a real life example. Let's say Jack is a cash-based taxpayer. To earn extra cash, Jack has to work as a DJ for December. Jack does a gig on Christmas Day 2023, and he receives a check from this company he's working on for that date. The company where he DJs dates the check though for January 2, 2024, and Jack is asked not to cash the check until that date, January 2nd. The income is not going to be reported for the 2023 because you can see there's a restriction on that check. And the last method will be the accrual method. Accrual method is pretty simple to understand. When using the accrual method, you report the income when earned, where the taxpayer had received it or not. The IRS consider the taxpayers to have earned income when all the events have been accrued that fixes the rights to receive such income and the amount that can be determined with a reasonable accuracy. Some examples for this will be like selling products where that you have like a receivable. That could be if the taxpayer is using this method, he will have to claim those incomes as they deliver the product. So it's all a strategy at the end of the day. And I'm not going to go into which one is better or anything like that. It just depends on the taxpayer, or it depends on the business. But anyways, guys, thank you for watching. I'll see you into the next one.